That's something traders are watching closely, especially after last month's data came in soft. There's growing momentum inside the White House to replace him with someone more aligned with Trump's economic priorities. If the current market conditions remain stable, we can expect the S&P 500 to continue trading to the upside, at least. Welcome to this week's market breakdown. I'm Isaac Martinez, trader and market analyst at XChief, and today we're diving into key technical setups across the DXY, S&P 500, Euro USD and Bitcoin, which just printed a historic all-time high at $118,000. What does this mean for crypto markets? Are we facing a turning point in equities and currencies? Let's analyze the charts and uncover what traders should watch closely in the coming days. First, we'll start as always with the economic calendar. Don't forget the hours you're going to see right now are based on GMT -5, which is related with the New York trading session. On Tuesday at 7:30 a.m., we'll get key inflation data from the US first. The core CPI month over month shows how much consumer prices are rising without including food and energy, which tend to be volatile. It's a strong indicator of inflation trends and can influence the Fed's interest rate decisions. Right after, we'll also see the general CPI numbers, both monthly and yearly, which tell us how prices for everyday goods and services are changing. If inflation is rising too fast, markets might react negatively, and rate hike fears could return. On Wednesday at 7:30 a.m., we'll shift our attention to producer inflation with the core PPI and PPI month over month. These reports measure how much prices are changing for businesses. If producers are paying more, they might pass those costs on to consumers, which could keep inflation elevated. That's something traders are watching closely, especially after last month's data came in soft. On Thursday at 7:30 a.m., we'll get an update on consumer spending with the core retail sales and retail sales monthly reports. These numbers help us understand how strong or weak the US economy is from the consumer side. Higher sales suggest economic growth, but if spending drops, it could be a sign that consumers are feeling the pressure from inflation or tighter credit. Also, on Thursday, we'll see the weekly unemployment claims. This data tells us how many people applied for jobless benefits. It's an early signal of what's happening in the labor market. A rising number could suggest job losses are picking up, which would be bearish for the market. And now let's start with the most important fundamentals of the week. Pressure continues to mount on Jerome Powell. White House Budget Director Russell Vought released a letter addressed to Powell, accusing him of mismanaging the Federal Reserve's finances, particularly pointing to a costly renovation project at the Fed's Washington headquarters. According to Vought, the project is running more than $700 million over budget and includes extravagant features like rooftop gardens, VIP dining rooms, private elevators, and custom marble finishes, drawing sharp criticism from the administration. This controversy comes on top of President Trump's repeated calls for Powell to cut interest rates immediately. Trump has publicly demanded Powell's resignation several times in recent weeks and even said he's open to Congress launching an investigation into the Fed chair's actions. Some administration officials are also pushing for Powell to step down after his term as chair ends next May. There's growing momentum inside the White House to replace him with someone more aligned with Trump's economic priorities, especially as two key seats at the Fed board are set to open up soon. Powell has defended the renovation project, calling the media reports misleading or inaccurate. He denies the existence of VIP suites or rooftop gardens and insists the project is compliant with the law. But oversight agencies are now pushing for a full review, and one Trump ally on the Planning Commission has already requested a site inspection. This tension is surfacing at a time when markets are extremely insensitive to any signals from the Fed. The possibility of a politically driving shift in central bank leadership could create additionally volatility. For traders and investors, it's a reminder that the Fed is not just an economic force, it's now a political battleground. Now we'll begin with the technical analysis of the key assets we monitor week after week. As always, we start with the strength of the US dollar represented by the DXY index. The first thing to understand is that we've seen a significant bullish move, which is still holding. However, we should remain cautious as this could simply be a correction within the broader downtrend we've been experiencing. In other words, this upward movement might just be a retracement before the bearish structure continues. Within the current trading range, we need to keep in mind some strategic levels. These include 98.899, 98.258 and 98.770. These could act as key resistance zones where price might react, grab liquidity, and then continue its decline. We're already seeing a reaction around the first level, 97.898, and if bullish momentum continues, and so far we haven't seen a clear rejection at that zone, price could move up toward the next levels mentioned. Of those, the 98.258 zone stands out as the most important due to a clear imbalance or price inefficiency that is available in that area. The market may aim to fill that gap before resuming the downward trend. From a bearish perspective, we should also watch several liquidity zones formed below, such as 97.271, 97.179, 96.859, and 96.689. These levels could act as support where the price might correct lower before continuing the downtrend, or alternatively sip liquidity and then push higher. When considering the broader context for the US dollar index, we must take into account the current economic uncertainty in the United States. This includes issues related to tariffs, macroeconomic data, and growing speculation about the possible resignation of Fed Chair Jerome Powell. If this uncertainty continues or intensifies, it could drive further weakness in the dollar, leading to depreciation against other major assets and currencies. Now moving on to the S&P 500, we've seen that the bullish trend remains intact and we are currently approaching one of the key zones we previously highlighted, around 6,291 level. This area was identified based on Fibonacci retracement levels, although it could also be measured using Fibonacci extension. From this zone, we might start to see a potential correction. On the other hand, if the S&P 500 breaks above this level and then pulls back to retest it successfully, that could provide the structure needed for a continuation of the upward move. The overall market structure for the S&P 500 remains bullish. Many traders and analysts still expect the index to reach the 6,400 to 6,500 range, so we can continue to expect bullish momentum, with buyers likely targeting higher levels. If that scenario plays out, the next key bullish target would be around 6,385. Now, regarding downside levels, while we can still consider them, the main focus should be on identifying key support zones. This includes 6,201, a strong support area, 6,132, another important zone visible on the chart, and an noticeable imbalance on vacuum zone around 6,102 level. If the current market conditions remain stable, we can expect the S&P 500 to continue trading to the upside, at least in the short to medium term. Now looking at the Euro-USD pair and considering everything that's been happening with the US dollar, the recent minor bullish movement in the dollar suggests we could continue to see downside pressure on the euro. This means the levels we've highlighted in previous weekly analysis remain relevant. Key support zones include 1.16455, 1.15903, and 1.14463. That will only happen in the case of a deeper drop. We need to be especially cautious if the market breaks below the 1.15903 level. A confirmed break could signal a continuation of the bearish structure, potentially leading to a much deeper correction. On the bullish side, if we see a weakening US economy or a drop in the dollar, the euro could begin to recover again. In that scenario, we could aim for the most recent high at 1.18299, even target the 1.19 level as a potential bullish objective. Particularly if you remain bullish on Euro USD, in the mid to long term. Finally, let's take a look at Bitcoin, one of the assets that has shown a very strong bullish breakout. As of Thursday evening, and this recording being made on Friday, we've seen a move of over $4,000. At the moment, BTC is trading near $119,000, which puts us on the verge of breaking above the 120,000 level if bullish momentum continues. However, with Bitcoin, we need to remain cautious. If we don't see a correction soon, we may be entering an emotionally driven rally, indicating a greedy market environment. While this could sustain the upside move for a while, it also increases the risk of sharp reversals. The 120,000 level is a major psychological and institutional target and could act as a strong resistance. Beyond that, the next key zones are 125k and 130k, and specifically 127k based on Fibonacci extension levels. On the downside, it's difficult to take advantage of any bearish opportunities in such a greedy market. However, there are a few zones to keep in mind for potential pullbacks or corrections. First, the $114,000 level, then $112,000, and finally a key area around $110,000, which could serve as a liquidity graph before the price resumes its climb. As a final comment, Bitcoin is now in a highly extended scenario. Personally, I would not be looking to buy at these levels. While the price can continue to rise, my personal approach would be to focus on taking profits from previous purchases, especially from positions accumulated during the market lows when BTC was trading between $14,000 and $15,000. If you found this analysis helpful, make sure to hit the like button and subscribe for more weekly insights. And don't forget, you can take your trading to the next level by opening an account with a trusted broker. Join us at XChief.com and become part of a platform built for serious traders. See you next time.